Right now, letters from HMRC are landing on doormats across this country addressed to people who have never paid a penny of income tax in their retirement and never expected to. Not because they've done anything wrong, not because they've come into money, because of a gap of £22. Your full new state pension this year is £12,547.60. The amount you're allowed to earn before tax, the personal allowance, is £12,570. That's a gap of £22.40. Which means if you have anything else at all coming in, a small works pension, or simply interest on your savings, you are now in the tax system, whether you plan to be or not. But here's the thing, almost nobody has told you. There is one ordinary, boring, high street account where HMRC cannot touch a single penny of what your money earns. Not now, not in 10 years, and not when the tax rates go up, which they are about to. My name is Robert, and two things have just happened that make this account more valuable for people over 65 than it has ever been, one of which the government has done specifically for your age group, and it barely got reported. There's also something every widow and widower in this country should know about, worth potentially tens of thousands of pounds, that banks will not chase you about. Both of those are coming later, so stay with me. Let me explain the trap you've been walked into, because none of this was your doing. The personal allowance, the slice of income you can have before income tax starts, has been frozen at £12,570 since April 2021, and it's set to stay frozen. Meanwhile, the state pension has been rising every year under the triple lock. It went up 4.8% this April. So year after year, the pension has been climbing towards a line that hasn't moved an inch, and this year, they've all but collided. £12,547 of state pension against a £12,570 allowance, £22 apart. What that means in practice is simple and rather brutal. For a great many pensioners, the state pension now swallows the entire personal allowance. So anything else, a modest private pension, a bit of part-time work, or interest sitting in a savings account, can be taxed from the first pound. People who genuinely believe they'd never deal with the tax office again are getting their tax codes changed, or a letter called a simple assessment telling them what they owe. And here's the part people find most uncomfortable when they learn it. Your bank tells HMRC. Every year, banks and building societies report the interest they've paid you automatically. You don't declare it, you don't opt in, it simply arrives at HMRC, and if you owe tax on it, they'll come and collect. So that's the problem. Now, let me show you the one place your money can sit where none of that applies. Quick one before I do. Tell me in the comments whether you've had a letter or a tax code change from HMRC in the last couple of years. Just yes or no. I genuinely want to see how widely this is biting, because the official numbers and what people actually experience aren't always the same thing. And if this sort of thing is useful, do consider subscribing. Plain English, every week, no jargon. I've also put the whole picture together. The state pension, this tax trap, pension credit, council tax help, care costs, into one guide with the 2026-27 figures, and it's linked below if you'd like it in one place. But everything you need for today, I'm giving you right here, free. Here's how the rest of this goes. First, why your ordinary savings account has quietly become a tax problem, including the allowance almost everyone has heard of, but very few people understand. And one honest exception that means some of you watching genuinely don't need to do anything at all. I'll be straight with you about that, because I'd rather you did nothing than something unnecessary. Then the account itself, what it actually is, why HMRC can't reach inside it, and the direct comparison in pounds and pence. Then the thing the government has just done, specifically for people aged 65 and over, which almost nobody noticed, and which means your age group is about to have an advantage that younger savers are losing. Then the one for widows and widowers, an extra allowance most people have never heard of, that banks don't chase you about, and that has a deadline. And finally, the single most expensive mistake people make when they finally decide to move their money, which can cost you an entire year's allowance if you get it wrong. Let's start with the problem. You may have heard that you're allowed to earn some savings interest tax free. That's true, and it's called the personal savings allowance. If you're a basic rate taxpayer, it's £1,000 of interest a year. If you're a higher rate taxpayer, it's 500. And if you're an additional rate taxpayer, it's nothing at all. Now, here's why that allowance has quietly stopped protecting people. It was set back when savings rates were on the floor, when you'd have needed a fortune in the bank to earn £1,000 of interest. It has not been increased since, but savings rates have risen substantially, and the result is that ordinary amounts of money now generate enough interest to breach it. Let me put real under £1,000 in a decent one-year savings bond at around 4.5%. That earns you roughly £900 of interest in a year. For a basic rate taxpayer, that just about squeaks under the £1,000 allowance. But for a higher rate taxpayer, whose allowance is only £500, a big chunk of it is taxable. And if you have £30,000 rather than 20, even a basic rate taxpayer is over the line. Taxpayers is over the line and paying tax on the excess. Now stack that on top of what we talked about earlier, the state pension eating almost your entire personal allowance, and you can see how someone with modest savings and no idea they'd ever pay tax again ends up with a letter. Let me make that real, because it's happening to people who've done everything right. Picture a widow in her 70s. She gets the littlest state pensions. She gets the full state pension. She has a small works pension from her years at the council, say £2,000 a year, and she has £40,000 in the bank, which is the money from selling the family car and some savings she and her husband built up over decades. Nothing extravagant, nothing anybody would call wealthy. Here's her position. The state pension has used up all but £22 of her personal allowance. So that £2,000 works pension is almost entirely taxable. She'll pay basic rate tax on nearly all of it. And her £40,000 in savings, at a reasonable rate, is generating well over £1,000 of interest a year, which breaches her personal savings allowance. So part of that is taxable too. Her bank reports the interest automatically. HMRC adjusts her tax code or sends her a simple assessment, and she is genuinely baffled because she has never earned above the tax threshold in her life, and nobody has explained that the threshold stopped moving while her pension kept rising. That's not an unusual case. That's an ordinary pensioner in 2026. And I want to say plainly, there is nothing you can do about the reporting. Your bank sends HMRC the figures automatically. This isn't about hiding anything, and I'd never suggest it. It's about which account your money is sitting in, because the tax treatment is decided entirely by the wrapper around it. And that's completely legitimate and completely within the rules. Now, the honest exception, because I promised it, and because some of you genuinely don't need to do anything, there's a lesser known rule called the starting rate for savings, worth up to £5,000 of savings interest at a 0% rate. But, and this is the catch, it shrinks as your other income rises above the personal allowance. So it's most useful for people whose non-savings income is low. For a pensioner whose only real income is the state pension, with the personal allowance nearly all used up but not much beyond it, there can still be meaningful room here. Potentially several £1,000s of interest taxed at nothing on top of the personal savings allowance. So if you're a pensioner with a modest amount in savings and no private pension to speak of, you may already be paying no tax on your interest, and you may not need to change a thing. That's the truth, and I'd rather tell you than sell you something. But the moment you've got a works pension, or your savings grow, or your interest rates rise again, that protection erodes. And that's when the account I'm about to describe becomes the answer. That interaction between your state pension, your allowances, and your savings is exactly the sort of thing I mapped out properly in the playbook with the 2026-27 numbers, because it's genuinely fiddly to hold in your head. It's linked below. Now, the account itself. The account is an ISA, an individual savings account. And I know some of you have just thought, oh, I know what an ISA is, but stay with me, because the specific thing it does is the whole point. And most people have never had it explained properly. An ISA is not an investment. That's a wrapper, not a vest. It's a wrapper. Think of it as a protective box you put ordinary savings or investments inside. And here's what the box does. Any interest earned inside it is never taxed. Any dividends inside it are never taxed. Any growth inside it is never taxed. And, this is the part people miss, it never appears on a tax return. It never touches your personal savings allowance, and it never gets reported to HMRC as taxable interest. As far as your tax bill is concerned, money inside an ISA doesn't exist. That's what I mean by HMRC can never touch it. Not that it's hidden, it isn't. It's a completely standard product sold by every bank and building society on the high street, written into law by the government itself. It's that the money inside it is genuinely outside the reach of income tax and capital gains tax, permanently, by design. Let me show you the comparison, because it's stark. Two people each put £20,000 away for a year at roughly the same rate. One uses an ordinary savings account and earns about £900 of interest, and depending on their other income, part or all of that is taxable, reported automatically, and collected through their tax code. The other uses a cash ISA and earns roughly the same. Their interest is tax-free, full stop. No reporting, no tax code change, no letter. Same money, same rate, same bank. Completely different outcome, decided purely by which account it went into. That's why I say your savings may simply be sitting in the wrong place. You can put £20,000 into ISAs each tax year. And here's the bit that compounds beautifully over time. That protection doesn't expire. Money you put in this year stays sheltered next year, and the year after, forever, while you get a fresh £20,000 allowance every April. Do that for a few years, and you can have a very substantial pot of savings that will never generate a tax bill for as long as you live. Let me put that in perspective, because people underestimate how quickly it builds. If you moved £20,000 across this tax year and another £20,000 next April, and again the year after, that's £60,000 of savings permanently outside the reach of income tax in 3 years. At a reasonable savings rate, £60,000 generates well over £2,000 of interest a year. Outside an ISA, a good chunk of that would be taxable and reported. Inside, it's yours in full, every year, and it never touches a tax return. And that's the quiet advantage here. It isn't a one-off saving. It's a permanent change to how your money is treated for the rest of your life. Every year that money stays sheltered is another year of interest HMRC never sees. If you're not sure where you stand right now, there's a simple check. Look at your last statement or two and work out roughly what interest you earned across all your accounts last year. Then compare that against your personal savings allowance. £1,000 if you're £1,000 if you're a basic rate taxpayer, $500 if you're higher rate. If you're anywhere near those figures, or if your tax code has changed without you understanding why, you're very likely already paying tax you could avoid. There are some of match fix between. There are always things för övernorp för sig cash types that så more inspirkt till spelt with mardamentals, and just that can be perpetual because the same derivatives at the park are just some of the way they are utilisational stone. Two main types obst hang suffix worth knowing. A cash ISA works exactly like an ordinary savings account. Your money is safe, it earns protected under the savings compensation scheme. Up to the only difference is the tax. I see only difference consider of in smutruvits. All your litters of sense is his shares. And a stocks and shares ISA where the money is invested rather than saved. I'll be honest with you about that one. The tax treatment is just as good, but the value can go down as well as up, and you can get back less than you put in. For most people at our stage of life, particularly for money you might need, the cash ISA is the straightforward choice. And nobody should be talked into investing money they can't afford to see fall. So that's the account. Now, let me tell you what's just changed and why it matters more for your age group than anyone else's. This is the part I promised you, and I think you'll be surprised because it barely made the news. In the autumn budget, the government announced that the amount you can put into a cash ISA each year is being cut. From the 6th of April 2027, instead of £20,000, most savers will only be allowed to put £12,000 a year into a cash ISA. The overall ISA allowance stays at $20,000, but the remaining $8,000 would have to go into a stocks and shares ISA where the money is at risk. The whole point of the change is to push people out of cash and into investing. Now here's the part that concerns you directly, and it's genuinely good news. If you are 65 or over, that cut does not apply to you. You keep the full £20,000 cash ISA allowance. The government wrote that exemption in deliberately. It's on their own website in the ISA reform documents, presumably because pushing pensioners out of safe cash savings and into the stock market was a step too far. Think about what that actually means. From April 2027, someone aged 64 will be limited to £12,000 a year of tax-free cash savings. Someone aged 65 will be allowed $20,000. You will have, quite simply, the most generous cash ISA allowance available to anybody in this country. That is not a small thing, and almost nobody in your age group knows it. And there's a second change stacked on top, announced at the same time, that makes all of this considerably more important. From April 2027, the tax charged on savings, interest outside an ISA, is going up by 2 percentage points across the board. Basic rate goes to 22%, higher rate to 42%, and additional rate to 47%. So put those two things side by side. Tax on ordinary savings interest, going up. Your cash ISA allowance, protected in full, uniquely, because of your age. The gap between money inside an ISA and money outside one is about to get wider than it has ever been, and you are the one group the government has decided to leave the door fully open for. If you were ever going to move savings into an ISA, this is not a bad moment to be looking at it. And it's worth saying clearly, anything you shelter in an ISA now stays sheltered indefinitely. None of these changes touch money that's already inside the wrapper. Now, the one I most want widows and widowers to hear. If you have lost a husband, wife, or civil partner, or if that day comes, there is an entitlement here that a great many people never claim because nobody tells them it exists. It has an official name that sounds like nothing, the additional permitted subscription. Most people just call it the inherited ISA allowance. Here's what it does. When someone dies holding an ISA, their surviving spouse or civil partner is entitled to an extra one-offs allowance equal to the value of everything in that ISA. And critically, that is on top of your own £20,000 for the year. Let me make that concrete. Say your late husband had £50,000 sitting in ISAs. You have your own £20,000 allowance for the year, as normal, plus an extra £50,000 allowance because of his ISA. £70,000 you can shelter from tax that year instead of 20. For a widow who's just inherited savings and is suddenly earning taxable interest on all of it, that difference is enormous. Now, 3 things about it that I want to be very precise about because this is where people trip up. First, and this genuinely surprises people, you get the allowance even if the ISA money itself was left to somebody else. It isn't the money you're inheriting, it's the allowance. So even if your husband left his savings to the children, you as the surviving spouse still get that extra allowance. And you can fill it with any money you like. It doesn't have to be his money. That's an important distinction and almost nobody understands it. Second, there is a deadline. You generally have 3 years from the date of death or 180 days after the estate has been fully settled, whichever comes later. That sounds generous, and it is. But 3 years passes quickly when you're grieving and dealing with everything else. And nobody will remind you. Third, and this is the crucial one, it is not automatic. No bank will write to you and offer it. You have to ask. You contact the provider or providers that held your spouse's ISAs, ask them for the value at the date of death, and apply. There's a form. Some providers accept transferred allowances from other banks and some don't, so it's worth asking. And it applies to deaths from December 2014 onwards. So if you lost your spouse some years ago and the estate has only recently been settled, it may still be open to you. If you've been widowed and you had no idea this existed, please look into it. And if you know someone who's been widowed, a sister, a neighbor, a friend from church, this is the sort of thing worth mentioning to them because the banks certainly won't. Now, the practical part. How do we actually move your money and the mistake that costs people a full year's allowance? Right, so let's say you've decided to move some savings into an ISA, or you've got an old ISA sitting somewhere on a terrible rate. Here is the single most important thing in this entire video, and people get it wrong constantly. Do not withdraw the money and pay it back in yourself. Ask for a transfer. Here's why that matters so much. If you have an existing ISA and you take the money out and then deposit it into a new ISA, that money has left the wrapper. Paying it back in counts as a brand new subscription and eats into this year's £20,000 allowance. So if you had £30,000 in an old ISA and you withdrew it to move it, you couldn't even put it all back in this year. And you'd have permanently lost years of accumulated tax-free protection on the excess. But if you do it properly, none of that happens. Every ISA provider offers an official ISA transfer. You go to the new provider, the one with the better rate, open the account, and fill in a transfer form telling them where the money currently is. They contact your old provider and move it directly, bank to bank. The money never leaves the ISA wrapper, and crucially, transferring old ISA money does not use up any of this year's allowance at all. You still have your full $20,000. So, never withdraw to move. Always transfer. That one sentence can be worth thousands of pounds of future tax-free growth. A few other practical points worth having. Rates on cash ISAs vary enormously between providers, and loyalty is punished. Old accounts quietly drift down to dreadful rates. So check what yours is actually paying. If it's poor, transfer it. It costs nothing, and it's mostly paperwork the new bank does for you. Ask whether an account is a flexible ISA. With a flexible ISA, if you take money out and put it back within the same tax year, it doesn't count against your allowance. That's genuinely useful if you might need to dip into savings. Not all providers offer it, so ask before you open. A split before you happen. You can split your $20,000 across different ISAs if you want, some in one, some in another, and the allowance runs from the 6th of April to the 5th of April, and it does not roll over. If you don't use this year's, it's gone. And be very careful about one thing. Nobody legitimate will ever ring you out of the blue offering you a special ISA with an unusually good rate. That is a well-known approach used by fraudsters targeting older savers. Real ISAs come from banks and building societies you approach yourself. If someone contacts you first, put the phone down. Before I finish, 3 things this account does not do, because I'd rather you heard them from me. 1. An ISA is not free from inheritance tax. This is a common and expensive misunderstanding. Your ISA is tax-free while you're alive, but when you die, it forms part of your estate like anything else, and inheritance tax may apply. The inherited allowance I described protects your spouse's ability to keep saving tax-free. It does not exempt the money from inheritance tax. Anyone telling you otherwise is wrong. 2. Money in an ISA still counts if you're claiming means-tested help. Pension credit and similar benefits look at your savings, and savings in an ISA count exactly the same as savings anywhere else. The tax wrapper doesn't hide it, and it isn't meant to. 3. A stocks and shares ISA carries real risk. The tax treatment is excellent, but the value can fall. If you're being encouraged to move cash into investments, especially with those 2027 rules pushing people that way, take proper regulated advice first, and never invest money you might need soon. So here's where that leaves you. The personal allowance is frozen. Your state pension has all but filled it. Your bank reports your interest automatically, and from 2027, the tax on savings interest is going up, while the cash ISA allowance is being cut. For everybody except you, if you're 65 or over. You've done nothing wrong to end up in this position. It happened through a frozen number and a rising pension, and nobody wrote to explain it. But the fix is genuinely simple, and it's sitting on every high street. Make sure the money you've worked 40 or 50 years for is in the wrapper where it can't be taxed, rather than the one where it can. If you've been widowed, ask about that inherited allowance. And whatever you do, transfer. Never withdraw. One last honest note. This is general information, not personal financial advice. Rates, rules, and allowances change, and everyone's circumstances are different. So do check the current position on gov.uk or with a regulated advisor before you move anything. And I'll say it once more, because it matters most. Never give your details to anyone who telephones you offering a savings account. You go to them, look after yourself, look after your family, and I'll see you in the next one.